So there is one major reason, if for nothing else, why you should be paying close attention to inflation. 2 years ago, many employers were very willing to benchmark your increase in salary against inflation. Well, 2 years ago, inflation was hovering around 2%. Fast forward to 2023, inflation is raging, and in the UK, places like the US and other places around the world, inflation has gone through the roof. Currently in the UK, inflation is around 10.5%. In the US, it's around 8.5%, and in places like Argentina, it's closer to 100%. So the data tells us that prices have pretty much doubled over time. Asian countries, inflation is sort of hovering between 2 to 5%, and in parts of Africa, inflation is in the high 20s. And from many employers' perspectives, it wouldn't make sense to increase salaries across the board by 10% or 20%. Now, if your salary isn't increasing alongside inflation, it means that you and I are pretty much losing out. And this is why you should care about inflation. But the bigger question is, what can you do about it? How can you insulate yourself, your lifestyle, and your finances against inflation? Let's talk about it. Hi, my name is Jumoke and I work as an investment banker. I'm a CFA charter holder as well as a CAIA charter holder. A very warm welcome to all of my new subscribers. Thank you so much for subscribing. So why should you pay close attention to inflation and how does it affect you on a day-to-day basis? Well, that's because inflation actually affects your purchasing power, your real purchasing power. In a simpler term, what that means is that inflation affects your affordability, how easy it is for you to afford certain things. This is because there is an ever increasing gap between what you could afford 2 years ago, 3 years ago, versus what you can afford now. And that is all around your purchasing power based on your income or your salary. And as I mentioned previously, most employers won't be willing to increase the salaries of all their employees across board by 10%. The numbers don't add up and that won't make economic sense. A year ago, a gallon of milk may have cost you around $3.50, but today that might cost you $4.80. So you can see there's been an increase in terms of the price of a gallon of milk. And this is how it affects you on a day-to-day basis. So let's take a step back. What is inflation? Inflation is essentially the increase in price levels of goods and services in the economy. Things such as feeding, accommodation, transportation, housing, and essentially the basic necessities of life. Now, the level of inflation differs from country to country. And this is precisely why it's important for us to pay attention to how we can mitigate or bridge the gap between our income and our affordability. Think about it. If your income is not increasing at the same pace as inflation, it means that your real income, i.e. your net income, is actually lower. So in this video, we will talk about ways that you could potentially bridge that gap between your income and your affordability. The first point is to invest in stocks. Now, we've seen stocks gyrate and fluctuate quite a bit over the last few years. And as I mentioned in the previous video, that's because of the stimulus checks and the quantitative easing that happened over the pandemic period by central banks around the world to ensure that they curb the effects of a recession. So now might not be a typical example of stocks increasing as inflation increases. However, we've seen certain industries do really well in inflationary environments. Industries and sectors such as commodities, oil and gas, energy, and utility. And that's because when inflation rises, the input costs in these sectors are passed on to the consumers. But historically, stocks tend to rise with a rise in inflation. However, it's important that you don't just invest in any stock. You do your research to ensure that you are investing in a fundamentally healthy and strong company. Another way you could invest is through index funds. That way you don't necessarily have to stock pick. You can invest in an index which will grow over time. The second way to invest alongside inflation is to invest in real estate. Now, I've mentioned real estate in previous videos because I believe it's just one of those sectors that is very rich in terms of opportunities. It's a sector that helps with your passive or residual income, and it's just a sector that has seen a lot of growth over time. And as I've mentioned in previous videos, quite a lot of people, a lot of wealthy people have made their wealth in the real estate sector. So you see there's something to be said for real estate, and there still remains ample opportunity for you and I to grow our wealth. One other way that you can invest in real estate if you don't have a surmountable capital to perhaps buy properties is to invest in what's called a REIT. Now, a REIT is real estate investment trust. That's what REIT stands for. So a REIT is essentially essentially a share. It's a stock that you can buy on the stock market. However, the underlying investment within a REIT is real estate or properties. So a REIT is a share in a company that really invests heavily in real estate. That could be commercial real estate, it could be residential, it could be office space, storage space, etc. Different REITs offer different coverage in terms of the underlying assets they invest in. And the beautiful thing about REITs is that they pay out dividends to their holders. So not only do you own shares in a company that is invested in real estate, you also get the benefit of cash inflow whilst invested. Number 3 is to invest in commodities. Now, unfortunately, not everyone is able to own gold, silver, oil, copper, etc. physically, but there are other ways to indirectly invest in these commodities. Again, going back to the stock market, you could actually buy shares in companies that operate in these industries. So for example, if you bought some shares of Shell, the oil and gas company, or perhaps ExxonMobil or BP, British Petroleum, it means that you own a share in these companies, you own part of their stock. Now, these are oil and gas companies and they operate heavily in the sector, which means that you are indirectly gaining exposure to the oil and gas sector. Another example is that if you are interested in the mining sector, you could gain exposure through investing in mining companies such as Glencore, Rio Tinto, Anglo American, etc. So to summarize, investing in commodities is another great hedge against inflation. The fourth way is to invest in inflation-protected securities. And most of these securities happen to be in form of bonds issued by governments. So one example is what's called TIPS, that's Treasury Inflation Protected Securities. TIPS are essentially bonds or securities that adjust their principal according to inflation. So as inflation goes higher, the values go higher, which means that you are protected or hedged against inflation. And of course, that is a fantastic way to protect your capital against a rise in inflation. So tied in with the bond asset class, there are other bonds that offer coupon rates, i.e. returns on your investment, that vary according to inflation. So the bottom line is you can actually protect against inflation or hedge your principal against inflation by investing in inflation protected securities. Number 5 is to use your talent. There's so many of us who are super talented at different things. You might be a creative person, you might be great at teaching, at IT, whatever it is you're good at. Offer those services from a freelance perspective. You can do that online, you can do that in person now that the world is opened up. There is a vast array of opportunities out there to use your talent and your skill sets to earn. And I will come on to passive income ideas in a different video, but for this video, the 5th way that you can really hedge your earnings against inflation is to go freelance, to use your talent and bring in or earn residual income. The last point, but certainly by no means the least point, is to negotiate your salary or your income. A lot of reasonable and rational employers won't want to lose their best workers. And if you're a good worker, there is every reason why you should try to negotiate your salary. If you never ask, you'll never know. But of course, you have to back this up with data, perhaps talking about how much you've increased in terms of your performance. Maybe that's through sales or business acquisition or, whatever it is. But the bottom line is you will need data to back up your claims or your request for a higher salary. So those are all the points I have for this video. I hope it's been helpful. These are some of the ways that I myself am investing alongside inflation and how I intend to protect my capital over time. Thanks to one of my subscribers who was very gracious enough to suggest talking about inflation, which I believe is a very timely and a very apt conversation to have, especially as we have a very high inflationary environment at the moment. It's very important to think about how you can insulate yourself and your capital against the rise in inflation. I do hope this video has been helpful. If it has, don't forget to click that subscribe button if you aren't already subscribed. Hit that notification bell so you don't miss any of my new videos. I'll see you in the next one. Bye for now.